In this lecture, we will cover the CFA Level 2 reading on discounted dividend valuation. This is a long reading, but it is quite straightforward. Approximately 75% of what you'll see in this reading should be familiar, but we need to still do this very carefully because it helps build on the concepts that you learnt at level 1 and strengthens those concepts. And then roughly 25% of the material will be somewhat new. This reading is the first in a series of readings that talk about different sorts of valuation models. The focus here is on how we discount dividends, but we talk briefly about other models also, like free cash flow and residual income. In general, when we talk about discounted cash flow valuation, we follow a certain process. And this term, discounted cash flow valuation, refers to a family of models. And we've also talked about this in earlier readings. There are 4 broad steps when we apply discounted cash flow valuation. The first is to choose the class of the DCF model, and effectively this means selecting the definition of cash flow. You are taking, let's say, a perspective of an equity investor, then what cash flow do you use? Either you can think of yourself as somebody who owns shares and your cash flow is the dividend, or you might define the cash flow as free cash flow to equity, and so on. So step 1 is defining the cash flow. Then you need to forecast the cash flows. Next, you select a discount rate methodology. What this means is that you have to come up with a discount rate, but what process will you use to come up with the discount rate? You could either use CAPM, or you could use a multi-factor model, or you might use some other model, and this is something that we have studied in an earlier reading. And then once you've decided on the model, then you need to use that model or set of models to come up with the discount rate. Let's talk about present value models in a little more detail. And this is section 2 in the reading. This has 2 subsections: valuation based on present value of future cash flows and streams of expected cash flows. What you are looking at here is an extremely simple concept, something that you studied at level 1 in quantitative methods and then in other readings. If you think of any financial asset, the value of that financial asset at time 0 is the present value of the cash flows that will be generated from that asset, discounted at a particular rate which represents the riskiness of the cash flows. And that is all that is being stated over here. If you think of owning a stock and your cash flow is the dividend, then instead of CF or cash flow, we will replace dividend, and this R becomes the cost of equity, which will be the appropriate discount rate. So this is example 1 from the curriculum, which is a very simple application of what we've been talking about. And if you have trouble with this, then I'd be very concerned. Let's say you have an asset with cash flows of 100 in 1 year, 150 in 2 years, 200 in 3 years, and you are given the discount, and you are given the discount rate. What's the value at time 0? It is simply the present value of the various cash flows discounted at 10%. What's the value at period 1? So you look at your cash flows at 0, 1, 2, and 3. The valuation at time 0 was based on the present value of the cash flows over here. What about the valuation at time 1? This will be based on the present value of the cash flow at time 2 and present value of cash flow at time 3. And obviously you knew that. Something else that again you should have seen at level 1, but just to reinforce the point, the asset's value is the value of future cash flows discounted back to that point. So at V1, we have a value based on cash flow at time 2 and cash flow at time 3. Now also note that to come up with the value at time 0, what you can do is take the cash flow at time 1 and discount it back, and then add to that the discounted value of V1, and that is what is being demonstrated over here. Section 2.2 talks about streams of expected cash flows. In present value models of stock valuation, the three most widely used definitions of returns are dividends, free cash flow, and residual income. Now, even within free cash flow, there can be different sub-definitions, and we'll see this in detail in the next reading, which is based on free cash flows. Here we will just talk about free cash flows generally. And then there is another reading on residual income. Again, there are multiple definitions of residual income that we will look at. Let's start with free cash flow. Free cash flow to equity is the overall cash flow that is generated by a company that is available to equity holders. And free cash flow to firm is the cash flow which is generated that is available to all investors, both bondholders and debt holders. So when do you use free cash flow based models or free cash flow based valuation? You use this when the company is not dividend paying. So obviously you can only use DDM if a company pays dividends, and there are more constraints which we'll talk about later. But if a company is not paying dividends, then you might use the free cash flow model. The company is dividend paying, but dividends significantly exceed or fall short of free cash flow to equity. In other words, the company is generating money and paying dividends, but the dividends don't have a clear relationship with the free cash flow to equity or the money that is being generated by the company. The company's free cash flows align with the company's profitability within a forecast horizon with which the analyst is comfortable. So the point is, you use this model when the free cash flow is in general aligned with the company's profitability. And you can use this model when the investor takes a control perspective, as opposed to a dividend model, which we'll see later, where the investor does not have a control perspective. The idea being, if you are a company, large company that is taking over another company, you can then possibly control the dividends. You can decide to pay more dividends or less dividends. And if you are going to change the dividends, then it doesn't make sense to use the dividend discount model. Then it makes sense to use the free cash flow model from which the dividends will be calculated. Another category is the residual income model. This is suitable when the company is not paying dividends, which is similar to what we had with the earlier model. And this can be an alternative to the free cash flow model. You can also use this model if the company's expected free cash flows are negative within the analyst's comfortable forecast horizon. As you'll see later, the residual income model is based on balance sheet numbers, in the sense that we come up with the value of equity, and the residual income in every period is equal to the overall income generated minus an equity charge. So you multiply the cost of equity with the amount of equity at the start of each period, and the difference between net income and the product of these two is called residual income. You forecast residual income and then discount back. Again, you'll see this in a lot of detail later. So the point is that since this measure is not using dividends, it's not using free cash flow, it makes sense to use this method for a company that doesn't have dividends and for which the free cash flows might be negative in the foreseeable future. And then finally, the focus of this reading is the DDM, dividend discount model. And in the context of this reading, I'd say these points are extremely important. When is it appropriate to use the DDM? It is appropriate when the company is dividend paying, which is obvious. Use the DDM when the board of directors has established a dividend policy that bears an understandable and consistent relationship to the company's profitability. And this point is very testable. Also, investors often use the DDM when they take a non-control perspective. in the sense that you are a relatively small investor, you are getting dividends, you don't have control over the amount of those dividends, so you have a non-control perspective. Let us look at example 2 now, and I want you to do this before listening to the answer or before looking at the solution in the curriculum. So if you look at Coke, the dividend is quite consistent. So it's 0.88, 0.88, and then after that, it is consistently $1 per share. So a naive observer might decide to use the dividend discount model. But when you go back to what we just talked about, the dividend needs to bear a understandable and consistent relationship with the profits or profitability. And clearly that is not the case with Coke. If you look at EPS, which is a measure of profitability, and you look at dividends as a percentage of EPS, which is depicted by the payout ratio, you have numbers all over the place, ranging from 39%, 140%, 270, and so on. So there isn't a consistent relationship. Therefore, you cannot use the DDM model for Coke. On the other hand, for HRL, other than an exception over here, generally the payout ratio is aligned with profitability. So it does make sense to use the dividend discount model for this company. And this is what the curriculum has to say. You can read this. I'll just emphasize this little point at the end. Valuation is always a forward-looking exercise. So just because there has been a consistent relationship in the past doesn't mean you automatically assume this will happen in the future. You need to understand what the company is saying. And if you believe that the past is a good depiction of the future, then you go ahead and use the DDM even for the second company. Coming now to section 3, and we will now talk about dividend discount models in more detail. Broadly speaking, we can either have a single holding period or multiple holding periods. And the idea here is straightforward. This connects to one of the examples that we talked about earlier. In a single holding period, as the name implies, you intend to hold your stock or your investment for one period. So how do you come up with the value at time 0? It is simply equal to D1, in fact, the present value of D1, plus the present value of the price that you expect at the end of period 1. So this is how you use the single period model. What about the multi-period model? Same idea, but you are getting dividends over multiple periods. So let's say you are getting dividends over 3 periods. Then what will you do? You will take the 3 dividends, discount back each of the 3 dividends. You will take the expected price at the end of period 3 if you are holding the investment for 3 periods, and then also discount back this price at the end of the 3rd period. As you are warming up, give this a quick shot. So this is fairly straightforward. Here are the 2 cash flows, the dividend and the price at the end of year 1, and you simply discount them back. What you should get is 50.14. Example 4 is slightly more complicated because we have multiple dividend payments, and we also expect a stock price of 40 at the end of 5 years. I think it is unlikely that you will get something this simple on your exam, but it is still possible. The only piece of advice I'd have here is that if you do get something like this, then use your financial calculator. You need to put this in as cash flow 1, this is cash flow 2, cash flow 3, cash flow 4, and then cash flow 5 will be this plus this. You plug in the discount rate of 10% and then compute the present value. So don't do what the curriculum does, which is shown right here. Conceptually, obviously, this is what the calculator is doing. But if you start doing this, then that will just take too much time. So recognize that this is what is happening in your calculator, but use the cash flow function of your calculator. and the answer that you should get is 34.76. Dealing with future dividends. Let's say that you can predict dividends over a 4-year period. So you have expected values for dividends over your 4 years. What do you do about dividends that will be received after 4 years? That's the question over here. And there are several ways of dealing with these dividends that will be received after 4 years. One is to assume some stylized growth pattern. And the classic model to use is the Gordon growth model, which you've seen at level 1 also. With the Gordon growth model, we'll assume a certain dividend, D4, and then we will assume that this grows at a constant rate, G, based on which you can use the Gordon growth model and come up with a value 1 period before D4. Another strategy or a related strategy is to use 2 distinct stages of growth, where you say, okay, over 4 years or a certain number of years, the growth is relatively high, and after that, the growth is stable at G. You can also have 3 distinct stages of growth, which we will talk about later. Determine dividends for a finite period, then forecast either remaining dividends based on a stylized growth pattern. We've talked about that. We can also forecast a terminal point and forecast a price at that terminal point, which is also related to what we are talking about. And this material will be covered in detail in subsequent examples. Section 4 deals with the Gordon growth model. You have seen this before, but here we will look at several aspects of the model. First, the relationship. The value at time 0 is equal to D1, which is also D1 into 1 plus G. So if you are sitting here at time 0, what you do is take the dividend at time 1 and then assume that this dividend grows at a constant rate G. Then the value at time 0 is equal to D1 divided by the discount rate minus G. There are several assumptions you make here. One is that the growth rate remains constant. The other is that the discount rate remains constant. And you also have to assume that R is greater than G. If R is not greater than G, then this model will not work. And finally, the dividends bear an understandable and consistent relationship with profits, which is one of the assumptions we talked about earlier. When you use a particular number for G, you need to determine whether the estimate for G is reasonable by comparing this number G with the nominal growth rate of the economy. So if you come up with G equal to 20%, and your economy grows on average at, let's say, 8%, this is the nominal growth rate, then there is a possible issue. It is not reasonable to expect that your company will grow at 20% in the long run, given that the economy is only growing at 8%. So you reevaluate this 20% number. And if you are still confident that this is correct, then what you can do is use a multi-stage model where you say that, okay, for a certain number of years, the growth is at 20%, but eventually in the long run, we need to be down to 8%. And that is illustrated here. So I want you to read this example and then I'll help you through the main points. So these are the main points. Your D0 is equal to 1.04. This is the dividend for the year that just ended. The growth rate is projected at 6%. This is the sustainable long-term growth rate. The discount rate is 10%. So what is the value at time 0? It is D1, which is 1.04 multiplied by 1.06, growing at 6%, divided by R minus G, which is 0.101 minus 0.06. When you do the calculation, what you should get is this number, 26.89. And then a classic question that keeps coming up is whether the current stock price or whether the stock is currently overvalued, undervalued. So this is fairly straightforward. You compare 26.89 with the current market price. So if the market price is 30.89 and you come up with this number, then clearly this stock appears to be overvalued. And why do we say appears to be? Because there might be some issue with your very simplistic model, or there might be an issue with the assumptions. So we cannot be 100% sure. That's why we use terms like appears to be. All right, let's look at example 6 now. And what I am going to do is just emphasize the most important points here. If you have time, you can pause and read through all this and try to solve it, but let's look at the key points. Net income during the past 5 years has been 7%. So we are talking about a particular company, MSEX, and we are told that the net income has been fairly consistent in that it has been growing at 7%, which is in line with the long-term growth rate of nominal US GDP. So this is a stable company, net income growing at a steady rate. So the indication is that it might make sense to use the DDM and more specifically the Gordon growth model, and the estimate for G will be somewhere around 7%. But then another question that should come to your mind before you can do this is whether the dividends bear a consistent, predictable, understandable relationship with profitability. And that is indicated here. The analyst feels confident in forecasting future earnings and dividend growth. The company appears to have a policy of small annual increases in the dividend rate, maintaining a dividend payout of at least 80%. So I've highlighted the facts that lead us to believe that the DDM is a good model. And these highlights, or the emphasis is mine. The emphasis is not given in the case. The reason I'm doing this is the material is fairly straightforward, and when you are doing your exam and you are looking at the case study, you need to be looking for statements like this to decide what model to use. This reading, it is easy because you know it is the dividend reading, so questions will be based on the DDM, but obviously that's not the case on your exam. Then you are given more pieces of information, and I'm not going to run through all the details. I'll just emphasize some points. Look at this data over here. You are given a raw beta of 0.7 and an adjusted beta of 0.8. So later, when you are told to use CAPM, based on the words that I will show you, the decision will be to use the adjusted beta. But I'm just pointing out that the case is giving you both. Another interesting point which connects with quantitative methods is this R squared. The R squared associated with beta is under 10%. And remember, beta is calculated using a regression. So we are told that we do have a beta, but what is our confidence in this beta? It is relatively low because the R squared is very low. And even though we'll use this beta, but we will not have too much confidence in the required return that we derive based on the beta. Okay, so now let's look at some of the questions. Calculate the Gordon growth model estimate of the value of the stock. This is going to be fairly straightforward. It's just the value at time 0 will be D1 over R minus G. And you are given all the variables. And then how do you figure out whether it is overvalued, undervalued? You will compare the current market price with what you calculate, and based on that decide whether the stock is overvalued or undervalued. How do you justify the Gordon growth model? You justify this model when you are fairly sure that the growth rate is going to be reasonably stable in the future. Then we use CAPM under the assumption that beta regresses to the mean. And this is what I wanted to emphasize. So they are not explicitly saying that use the adjusted beta. But if you recall from an earlier reading, the assumption is that beta sort of moves towards 1, right? Which is another way of saying regressing to the mean. What's mean beta? Mean beta is 1. So based on this, do you use the raw beta or do you use the adjusted beta? You have to use the adjusted beta. All right, so the rest is fairly self-evident, and I would want you to go over the solutions presented over here. And I would emphasize this part, the solution to 3, where are you comfortable using the GGM? All right, example 7. Now, if you have time, you can go through all of this, but what I will do through this lecture is at least make sure that you understand the key point associated with most of the examples. In this particular example, the point made is that whatever value you come up with using the Gordon growth model is very sensitive to your assumptions about the input values. And that is depicted over here. If we assume a discount rate of 9.25%, and then even a 0.25% variation in the growth rate causes a substantial deviation in the value. So if you think about a market price of about 20.5 versus 24, that is almost a 30-40% difference in the stock value that you are coming up with, given only a 0.25% change in growth rate. Also, if you assume a given growth rate, then what happens to the value using different discount rates? Even if you have a 0.25% variation in the discount rate, there is a substantial impact on the value that you come up with. So that point is made here in the bottom line. The best estimate gives a value of 22.18, but the estimate is quite sensitive to small changes in inputs. Keep that in mind. Example 8 deals with the valuation of a preferred stock where we have a fixed rate, and this is something that you saw at level 1 in corporate finance. So here you simply use a regular perpetuity. If you have a stock which gives a dividend of $1 forever, the required rate is 9%. What's the value over here? It is the cash flow, which is 1, divided by the discount rate of 9%. So your answer is 11.11. What if you have a negative growth rate? Then can you use the Gordon growth model? Now, it might surprise you that we can actually use the Gordon growth model when we have a negative growth rate. All we do is plug in that negative number. So this also emphasizes a point that you should know intuitively, and I'll make that point and then demonstrate that with this particular example. According to the Gordon growth model, your value at time 0 is D1 over R minus G. Given a particular D1, your value will be high if this denominator is relatively small. And what is it that causes the denominator to be small? A relatively low discount rate, because you are then discounting future cash flows at a low rate, and a relatively high growth rate. So if you have a high positive growth rate, obviously the G still needs to be less than R for this model to work. But notice a relatively high G will make the denominator relatively small and will give you a relatively high value for V. What about a negative growth rate? Is that possible, first of all? It is, because you have a dying company. Should a dying company have some value? It should. Even a dying company will be paying dividends. Maybe the dividends are coming down slowly, but the value will still be equal to the present value of the future dividends according to this model. What happens with a negative G? Then effectively what you have is D1 over R minus a minus number. So the denominator becomes quite big, which means that the value comes down. So that is demonstrated here. If you have a growth rate of negative 10%, then you plug in minus 0.1. and the denominator overall becomes 0.22, which is a relatively high number, and your value is 19.32. So bottom line is that you can use a negative growth rate in the Gordon growth model. But I'll emphasize the required rate of return still has to be greater than G. And is that the case with a negative growth? Yes, obviously, with a negative growth, by definition, this will hold true. Next point, what is the link between dividend growth, earnings growth, and value appreciation in the Gordon growth model? Many people wonder about this G. So what is G? Is it the growth rate of earnings? Is it the growth rate of value? Is it the growth rate of share price? Is it the growth rate of earnings? And the specific definition is going to be covered on this slide. But first I'll illustrate a point. When you use the Gordon growth model and you assume a given growth rate of G, let's say G is 3%, and you hold R constant, let's say we are holding this constant at 10%, then the dividends and the value grow at the same rate. So here is a simple interpretation. The value at time 0 based on the Gordon growth model is D1 over R minus G. And remember, we are assuming that R and G stay the same. What is D2 and at what rate is the dividend growing? D2 is simply D1 into 1 plus G. So the dividend is growing at a rate G. What about the value? If you think of D2 as D1 into 1 plus G and the denominator is staying the same, then notice that the value is also increasing at a rate of G%. So that is the point here. It's very straightforward. Dividends and value grow at a rate of G. So the G in the Gordon growth model is the rate of value or capital appreciation. So G is the rate of appreciation of value. Sometimes also called the capital gains yield. So if your value increases from 100 to 110, what is the capital gain? It is 10%. Some textbooks state that G is the rate of price appreciation. Is there a discrepancy between these textbooks and what we are saying here? If prices are efficient, which means that the market price is equal to the value, then price is indeed expected to grow at a rate of G. Okay, so only in efficient markets. But if there is mispricing or we have inefficient markets, then the price is different from value. So then the change in price will depend on how quickly and whether the mispricing goes away. And this is something we saw in an earlier reading. But theoretically, G stands for the rate at which value is increasing, not the rate at which price is increasing or decreasing. Because changes in price also depend on what's happening with mispricing and whether the mispricing is going away or not. So just remember the fact that G refers to the rate of change of value. And for most of our practical examples, G then will also translate into the rate at which dividends are increasing. The components of total return stay constant if price tracks value exactly. Now, what is your return if you have this particular model? Let's say that we have an efficient market, then your price at time 0 is D1 over R minus G. And if you use some basic algebra, then what is R equal to? R is equal to D1 over P naught plus G. So this is saying that these are your two components of return. This is the dividend yield, D1 over P naught, and G is the rate at which value is increasing. And over time, as the value increases, your dividend is also increasing at a rate G. So the dividend yield will stay the same. And we are assuming that the growth rate is constant. So that means that the capital gain component will also stay the same at G. Section 4.3 deals with share repurchases, and this is material you've largely seen in corporate finance at level 1 and level 2. A few basic points and then I'll come to the important bottom line. Obviously, when there is a share repurchase, the number of shares comes down. Here, a company is buying back shares from shareholders, so shareholders are returning shares in exchange for getting cash from the company. Unlike cash dividends, a share repurchase doesn't set a precedent. Evidence suggests that over 2-year periods, repurchases are related to earnings. In other words, if company earnings are increasing, then the amount of money paid back to shareholders in the form of regular dividends or repurchases generally will also increase. For analysts, it is hard to predict repurchases though. And also remember from earlier lectures that with a repurchase, there is no impact on shareholder wealth. With a repurchase, the value of the share comes down, but that is compensated by the amount of money that the shareholder receives. Now, you are a financial analyst and you are valuing a particular company using the DDM. How does the fact that the company is doing share repurchases impact your analysis? What you have to do here is think of the company holistically and think of the total amount of money that the company is giving to shareholders. So when the company pays a regular dividend to shareholders, that is one way of compensating shareholders. If a company is buying back shares, that is another way for the company to give money back to shareholders. So what you need to do is compute the present value of all these cash flows. And then you will come up with the value, a present value, and that will have to be divided by the number of shares outstanding to come up with the estimated value of the share. So key point is to forecast total earnings and total distributions. When we say total distributions, we are referring both to the regular cash dividends as well as the share repurchases. The implied dividend growth rate. This is fairly straightforward. It is something that we've seen before. Given a share price and given a required rate of return, can you compute the growth rate that is implied by the current share price? This is just basic algebra. We use the same model that we've been talking about. Assuming efficient markets, P naught is D1 over R minus G. So we are saying that, let's say that the current market price is 40. So we plug in 40 over here. D1 is 2 multiplied by 1.05. The discount rate can be computed using CAPM. So we are given all these numbers. You are given the beta, the risk-free rate, and the equity risk premium. So you can compute D1, you can compute R, then you can also compute G, which is implied by the current market price. And just as a refresher, this is something that we saw earlier. When you come up with the implied growth rate, you can figure out whether that growth rate is reasonable or not. If you come up with a growth rate of say 15%, which is much higher than what you think it should be, then does that mean the stock is overvalued or undervalued? This would mean that the stock is overvalued because the current market price is assuming a rate that you think is unreasonably high. So that would imply that you believe that the stock is overvalued. All right, almost everything that we have discussed so far is material that you have hopefully seen before and hopefully you recognized. This is the first somewhat new concept that we'll talk about. You can think of the value of a stock as having two components. One component is the value of the company assuming zero growth, and the second component is the present value of growth opportunities. So take a simple company where let's say that the value is the same as the price is equal to $50. Now, what do we mean by the value of the company assuming zero growth? If you have a company which is generating earnings, but there are no profitable opportunities, so what do you think such a company should do with the earnings? Those earnings should then be given to shareholders. And if you just assume that your earnings are E1, so let's say that the earnings on a per share basis equal $2. And for this particular company, the required return is 10% or 0.1. What is the value of the company assuming zero growth? $2 equals earnings. What should happen with these earnings given no growth, no investment? This money should be given to shareholders. So $2 also then becomes the dividend. If the company is not growing, then the assumption is that the $2 earnings is not being invested because there are no profitable opportunities. So this money is given to shareholders. And to come up with the value, we say $2, which is what shareholders will get every year forever, divided by the discount rate of 0.1 gives a value of 20. So assuming no growth, the value of the company would be 20. But the value is actually 50 per share. So this means that the remaining 30 must be because the company is growing. And this 30 is called PVGO, which stands for the present value of growth opportunities. So that is the relatively straightforward concept over here. So here are the formulas. The value at time 0 is equal to E1 over R. What is E1 over R? That is this component, the value of the company assuming zero growth. And then what is this component? That is the present value of growth opportunities. We don't need to go into the calculation of PVGO. All we do is look at PVGO as a plug. And what do I mean by that? You have the value, you compute E1 over R, which is a simple perpetuity formula, and then the difference of V0 and E1 over R is your PVGO. Assuming price equals value, an efficient market in other words, then you can divide both sides by E. First you can actually replace V with P because we are assuming they are the same. And then if you divide both sides of the equation by E1, what do you have on the left? You have the leading PE ratio. On the right you have 1 over R because this E1 will cancel out, plus PVGO divided by E1. All right, now let's just look at some companies and look at what component of the price is given by PVGO. These numbers are from October 2008. If you look at a company like Google in 2008, would you expect PVGO to be a high percentage of Google stock price? You would, and that is exactly what we see here. In October 2008, Google stock price was 332. E over R was 115, which meant that the component of the price given by the present value of growth opportunities was 216, or roughly 65% of the overall price. A company like McDonald's has PVGO over price equal to 28%. What does that tell us? That tells us that there is reasonable growth. So a fair part of the price comes because of the current earnings, and approximately 28% of the price is because of the expected growth of McDonald's. And then the third scenario is Macy's, a large retailer in the US, which is facing stiff competition, and it is expected that the dividends and the earnings are going to come down. If that is the case, then you actually have a negative PVGO to price. So negative number here implies that the earnings are expected to come down relative to current levels. Okay, back to material now, which you have seen before. The Gordon growth model and the PE ratio. Hopefully you remember this from level 1, but we have the concept here of the justified or the fundamental PE ratio. The price of a share, assuming an efficient market, is equal to D1 divided by R minus G. If you divide both sides of the equation by E1, then you have P0 over E1, which is the leading PE ratio. And on the right, you have D1 over E1, which is essentially the payout ratio. So P0 over E1 is the payout ratio divided by R minus G. Why is this number called the justified PE? It is called the justified PE because the number that you calculate here is justified by the fundamentals of the company. The dividend is a fundamental number related to the company. The earnings also is a fundamental characteristic of the company. The discount rate is for the company. The growth rate is for the company. So you are taking company fundamentals and using those fundamentals to come up with a PE. So that is why this is called a justified or fundamental PE. Now, is this number, the justified PE ratio, will this be the same as the actual market price divided by the actual earnings? Maybe, maybe not. For a fairly priced security, the two will be roughly the same. If the PE is too high, the market PE is too high, that means that the share is overvalued. All right. 1 minus B, the curriculum keeps using the symbol B, and the way you remember this is 1 minus B is the payout ratio, which means that B must be the retention ratio. Okay, so just remember this, B is the retention ratio. Now we are talking here about the forward PE, and just as a quick reminder, forward PE is the current price divided by the earnings in the upcoming period. What about the trailing PE? The trailing PE is P0 over E0, and here again we look at the justified or the fundamental trailing PE. So what do? I'll just show you the mathematics here. We use the same expression, P0 is equal to D0 into 1 plus G divided by R minus G. So this is simply D1, same formula. But since we want the trailing PE, we will now divide by E0. So divide the left by E0, so you also divide the right by E0. What then is the trailing PE? It is equal to, what's D0 over E0? This is again the payout ratio, which can be written as 1 minus B, the retention ratio, into 1 plus G divided by R minus G. So you need to derive this at least once in your life, and then remember that this is the trailing PE ratio and this is the leading PE ratio. Now here is a basic question. For a growing company, will the leading PE ratio be higher than the trailing PE? Alright, so this is an important question. When I say growing over here, I mean that the earnings are growing and the dividends are growing. So given that assumption, the leading PE will actually be lower than the trailing. And the idea is very simple. The numerator in both cases is the price at a given point in time. For a growing company, I've already said that the earnings will be higher. So if the company is growing, then the denominator is higher with the leading PE. Therefore, the ratio will be lower. And you can also see that mathematically with the trailing PE, we multiply the leading PE. So this part is the leading PE by 1 plus G. So the trailing PE has to be bigger, both mathematically and logically. A general point made in this section in the curriculum is that analysts can use PE to determine whether the implied growth rate is reasonable or not. So what does this mean? You look at the actual market PE and you look at the fundamental PE that you compute over here, and if the two are the same, then that would imply that the growth rate is reasonable. Alright, so read this and try to solve example 11. So here is what you do. First thing is to compute the discount rate using CAPM, and you are given the relevant data. The discount rate you should get is 9%, the risk-free rate plus beta into the equity risk premium. Then you can compute the payout ratio given these two numbers. To compute the payout ratio, the earnings and the dividends have to be for the same period. The trailing earnings are 3.22 and the current level of annual dividends, which come from these earnings, equal 1.03. The payout ratio is 0.32. The leading PE ratio is the payout ratio of 0.32. And here we are assuming that the payout ratio stays the same, divided by R minus G, and that is 16. The trailing PE ratio is the leading PE ratio into 1 plus growth rate, that is 17.1. This answers question number 1. What about 2? Based on the justified trailing PE and actual PE, judge whether the stock is fairly valued, overvalued, or undervalued. So what do you do here? You have to look at the actual PE, which is 47.46 divided by 3.22. Should you compare this with the leading or the trailing PE? This should be compared with the trailing PE because you are taking the stock price and dividing by E0 or the trailing earnings. So that number based on actual market price is 14.7. You compare 14.7 with 17.1, the trailing PE. So is this overvalued or undervalued? This appears to be undervalued. The PE is lower than what you think is justified. Therefore, unless there is some other important piece of information, you would be inclined towards buying the stock. Here is the solution from the curriculum. Estimating a required return using the Gordon growth model, and this is fairly straightforward. All we are saying is that based on the Gordon growth model, assuming that the market is efficient, you can say that P0 is D1 over R minus G, and I've done this before. You can rewrite this formula in terms of R, and you will then have this expression. So R is equal to D1 over P0 plus G, and you can compute R. The discount rate R is technically an IRR. What is IRR? IRR is that rate which makes the present value of the future cash flows equal to the initial investment. When you buy a stock, what's that investment? It is P0. What is the present value of the future cash flows? It is D1 over R minus G, assuming constant growth. So notice that given a P0, given a D1, and given a G, R is simply that rate which is making the present value of future cash flows equal to the current price, which is technically the definition of IRR. So that is all that we are saying over here. Also, another obvious point, the rate R is composed of two components, the dividend yield and the capital gains yield, which is G. And this is something we've talked about earlier also. So this is a very straightforward, I've taken an excerpt, so solve this. Here is what you should come up with. The required rate is 9.67. You simply plug in the numbers. The expected return can be broken into the two components, the dividend yield of 4.17 and the capital gains of 5.5. Notice that the dividend yield is D1 over P0 because you are buying the stock for P0, and on that purchase price over the year you are making a dividend or getting a dividend of D1. So that is the dividend yield. And the concluding remark for section 4, the Gordon growth model is the simplest practical implementation of discounted dividend valuation. This is just a warning that more complicated things will be showing up later. The Gordon growth model is appropriate for valuing the equity of dividend-paying companies when its key assumption of a stable future dividend and earnings growth rate is expected to be satisfied. Obviously, we need to assume a steady, stable, sustainable growth rate also. Broad equity market indices of developed markets frequently satisfy the conditions of this model very well. So if you are taking a macro picture and you are trying to figure out whether the US stock market is currently overvalued, undervalued, then what this statement is saying is that generally speaking, on average, the stocks in a given exchange will grow at the rate of the economy. So there will be some sustainable growth rate. So very often financial analysts use the Gordon growth model to figure out whether a given equity market is overvalued or undervalued. When you are taking specific companies, then it makes sense to use the Gordon growth model when the company is now expected to have stable growth. If a company is going to have supernormal or very high growth in the short run, then you can't directly use the Gordon growth model. Then you need to use multi-stage models, which we will talk about.